Good afternoon and welcome to HYCM's webinar with myself, Giles Cochran, a currency analyst. Welcome to the FX week ahead. We've got a lot to get through this week and it's a very busy week that's coming up. So I'm really looking forward to sharing and looking ahead so we can navigate our way through the market that's coming up. Just before we get into the session properly, please could you just let me know that you can hear me okay? I always like the reassurance of knowing, oh yeah, Daniel, thank you, Daniel, you're here, that's great. If someone could just let me know you can hear me okay, that would be appreciated. Let's see, Adams, welcome. Bernard, La, Rami, Tian, Shaikh, welcome. That's great. Oh, thank you, Rami, that's great. You can hear me loud and clear coming through. It's always nice to have that reassurance. Great. Well, we're going to be looking at the week ahead. So as we look at the financial markets, it's always very important to understand the context within which everything's happening. So it's important for us this week to just to look back and to see some of the important developments that's going to have an impact on the coming week. So the first thing to look at is the European Central Bank met last week, and there was some speculation that they were going to deviate from their current policy. Their monetary policy at the moment is to end the quantitative easing purchases in December of this year, and then to hike rates in the summer of 2019. And what happened is there had been quite a large fall in the stock market, which if you've been following the financial markets, you would have seen there was some big drops in the European and the Asian and the US stock equity markets. And the speculation was that perhaps this situation would lead to the ECB changing their monetary policy. Also, they had the Italian budget concern, which we'll cover in a little bit of detail during the rest of this seminar. And so a number of those factors, slightly slowing growth in the Eurozone, the equities falling, the Italian budget problem, you can quite quickly see there was a number of negative factors that had some people speculating, would the ECB change their monetary policy? Well, no, they didn't. What Draghi essentially said is that the slowdown in the Eurozone activity was more a dip, and it wasn't a significant U-turn or a significant downturn, just a sort of a loss of forward momentum. He also stressed that that he expected there to be a pickup in core inflation, and he sort of shied away from getting too much into the politics between the European Commission and the Italian budget deficit. So as a whole, what he said is he's staying on autopilot. We're just sticking to our course. So we're going to be raising interest rates in the summer of 2019, and we're going to be ending our quantitative easing asset purchases in December of this year. So slightly moving away from an easy monetary policy and moving away from that accommodative monetary policy stance. That's essentially what Draghi was saying. So, but the thing is, looking forward, if there is a further downturn in ECB in the Eurozone growth, then obviously these questions are going to be re-emerging. So that's the situation with the European Central Bank. Have it in your head. Everything's staying as is, but if there's more downward growth, so if the Eurozone GDP that's coming out this week is a poor reading, we'll cover it as we look at the week ahead, but that would weigh on the euro a little bit and increase speculation about the ECB changing its monetary policy outlook. The next issue for us to look at is the risk of Brexit, no deal, is increasing for the UK. Now, we've been covering this in some detail because it's having a huge impact on the pound. And last week, the context of the Brexit deal has simply been this. Britain has left the European Union, and Britain is now negotiating with the European Union about the nature of its relationship after it's left. Now, 95% of that relationship has been pretty much organized, and both parties are clear and happy on that relationship. However, there's one aspect that is creating a big problem for both sides. And the problem is to do with the border in Northern and Southern Ireland. Now, when you think about the UK, the United Kingdom consists of England, Ireland, Wales, and Northern Ireland. So Northern Ireland borders Southern Ireland, which means when Britain leaves the EU, there will be a border between the UK and the EU, and the place of that border is between Northern and Southern Ireland. Now, politically, that border between Northern and Southern Ireland has resulted in a lot of problems between Northern and Southern Ireland. There's been what's been referred to as the Troubles. There's been a tremendous amount of violence between partisan groups. And for those of you who are unfamiliar with the situation in the Northern and Southern Ireland border issue, essentially it's very highly charged. So the idea of having a hard border there is completely unacceptable to the United Kingdom. And Theresa May has had to do a deal with a party in Northern Ireland called the DUP in order to make sure she had a majority in the UK Parliament. So if the DUP in Northern Ireland don't like the deal that Theresa May strikes up with the European Union, then she's going to lose her majority in the UK Parliament. So it's very finely balanced. And no matter how hard she tries, Theresa May can't convince the EU to have a solution that means there's no border between Northern and Southern Ireland. And it's becoming very difficult. Now, the consequence of this is Theresa May keeps trying to find new deals. And each time she tries to find a new deal, a way around this border problem, it falls on deaf ears. So she can't find a way through is the big picture. And then when she comes back to her own party aren't happy with the way that she's negotiating with the EU. So she's in a very hard situation. And this means the risk of a Brexit no deal has increased for the UK in the last week. I just wanted to show you a quick little infographic that tells you the timeline of what's happening. Now, in the 29th of October, which is today, the UK is announcing its budget. Now, the UK's Chancellor, Philip Hammond, has said that the budget is announced, but it might have to change if there is a no-deal Brexit scenario. So that's the first event that's happened now. Then we're going to have the Bank of England meeting. We'll cover that in the week ahead in a moment. Now, it had been hoped that November would have been a good time for the Brexit negotiations to be finalised. Originally, it was October, but that failed. Then it was hoped to be November, but that's looking very unlikely. And now it looks like this is going to be the almost like not a last chance, but the last significant time for the EU Council to meet and to agree a Brexit negotiation. Now, if that does get agreed, then the UK Parliament has to vote on any withdrawal agreement. So the scenario is just if Theresa May suddenly says we've got a deal, that's not the deal done. It's obviously good news, and the pound will most likely rally on that news. But what has to happen is UK Parliament has to vote and to decide that it wants to go ahead with that deal. So there's a two-tier process. So first of all, make the deal, and then in mid to late January, it will be for the UK to agree the deal, and then 29th of March, the UK formally leaves the EU. So that is the kind of the timeline for what's going to be happening with the Brexit negotiations. Now, in this kind of scenario, the way you can trade this, and again, this is not advice, but this is education. When you have a scenario, a political scenario like this, the pound will move very quickly to any headlines that indicates that a deal is going to be done or whether a deal is not going to be done. And so the way to trade these kinds of geopolitical situations is to have a squawk. There's Rand squawk or there's live squawk, and that literally squawks out the news as it happens. And then the pound moves very quickly on significant headlines. So for your education, an example of a significant headline would be something like, EU agrees terms of Brexit withdrawal. Ooh, bang, the pound will rapidly appreciate on that single headline. Similarly, if, around the 13th of December, the EU Council are meeting, and if the expectations running up to it, Theresa May says, "Oh, we've got a really good negotiation. It's looking really positive." The EU say, "Yeah, we really want to do a deal with Britain." And then 13th of December, the EU Council says, "No, we can't do a deal. The pound's going to fall very quickly." So that's the way that a professional trader will use a squawk and the news headlines to make very short-term trades, literally just the short-term initial spike of a movement to take 30, 40, 50 points out of the market. Then, depending on what the nature of the news is and how significant it is, then traders can look to re-enter using technical analysis in order to do so. So that's just a little heads up and an awareness for yourselves to look out for Brexit headlines. And in the week ahead, it's likely to carry on happening, and it's going to be continuing. And this is a little timeline for you. The next significant time for the EU to agree a Brexit negotiation would be the 13th of December. There's an outside chance that there's an emergency meeting in November, but this is the one it's really looking like. And the formal time the UK will leave the EU is the 29th of March. So there's just some dates for you to have in mind going forward. Now, without Brexit, there would, if there was no Brexit at all for the UK economy is not doing too bad, and there could well be a rate hike within the next 3 to 6 months. So I just want to show you this. The UK wage growth is risen to a 10-year high. Average earnings, excluding bonuses, delivered 3.1% growth. So wages have been increasing in the UK, and you can see the general trend has been higher since 2017. Now, the reason wage growth is important is because as wage growth increases, this adds to inflationary pressure, which in turn leads to higher interest rates. Once inflation starts getting above 2.1, 2.2%, and the way to keep inflation down is to raise interest rates. So the inflation data out in September 19th for the UK was up at 2.7% versus 2.4% expected. So looking at the UK, aside from Brexit, the growth is quite good. We have wages picking up, the CPI data is picking up. Then you could start to look, if there was no Brexit scenario, for a interest rate rise maybe within 3 to 6 months. So if I just look at let's just look at the pound. We'll go to the pound US dollar chart. Now you can see the pound has been weighed quite heavily on the negative Brexit sentiment. But if the Brexit scenario gets agreed and there's no further delay of Brexit, then we're going to see the pound rally. And the pound could rally quite considerably on the Brexit deal being arranged. At the moment, on the weekly chart, we can see there's a hidden technical bearish divergence. Now, a hidden technical bearish divergence is when you have an indicator making a higher high and you have price making a lower low. So if you see technically, you do there, you can see the indicator. It's making higher highs, and you can see price is making lower lows. Let me just put that on. There we go. That's it. And you can see that those two line up. So you can see that this point and that point line up, that point and that point line up there. So price is pressured to the downside, but if Brexit negotiation gets organized and sorted, we're going to see the pound rally. So what some traders are doing, again, this is not advice, but what some traders are doing, they're putting very large stops on. So they're having a stop, running their stop down below, 1.1800, 1.700, and just playing the long view on the view that eventually the Brexit deal will be arranged and organized. Obviously you would affect your position size. I'm against that because I think there is a significant risk of the Brexit deal not going ahead and there being a hard Brexit. And of course, if there was a hard Brexit, there would be a very sudden drop in the pound. And you can see here the UK referendum result here was a huge drop in the pound as soon as that happened, and I would anticipate a very similar response if there was a no-deal Brexit going ahead, and then most likely you would see a drop in UK interest rates. So that's not something that I would be looking to trade, but I wanted to point it out to you because some traders are taking that view that there will be a deal done. But it's very hard to see how the hard border problem with Northern Ireland can actually be sorted out. Going on to the next interesting aspect is Italy's budget deficit. Just to remind yourselves of this story, this is weighing on the euro, and Italy had a new government in March of this year, and the new government decided to run their budget at a deficit, and the deficit was outside of the EU guidelines. Now, instead of the Italian government saying we're going to revise our budget deficit to keep it in line with the EU guidelines, they essentially said we don't care what the EU thinks, we want to do what the Italian people want, and they took a very combative view to the EU. And some commentators have said that there's an underlying kind of suspicion that this is because Italy's government wants to leave the European Union. Obviously, this is going to be very negative sentiment for the euro, and we looked last week at the widening spreads between the German and Italian bonds, and those that widening difference between those two bonds was just showing the market is getting quite spooked about the possibility of Italy leaving the EU, and the amount of debt that Italy has is large, and all of this has been weighing on the euro. Now today there's a little bit of more relief has entered the market. We've seen the FTSE recover, we've seen the Italian bonds recover, we've seen the German DAX recover, and we've seen S&P 500 futures recovering as well. So the equity markets are lifting up. There wasn't much of a risk-off sentiment in Asian markets overnight. So at the moment, the market is in a kind of a risk-on scenario, and this budget deficit issue is just pushed to the sidelines for now. But what happens in the markets is these problems emerge and re-emerge, and the market forgets and then remembers them and forgets and remembers them. So this is just one aspect for you to have firmly in your mind. Oh, what is the EU, Rahul? That is the European Union. Okay. Just had a question here. Oh yeah, and Ro, the way you get previous webinars is you go onto HYCM's webinar and you just go to education, and education, you just go to webinars there. That's how you get the previous webinars. Okay, Ro, I hope you find that now. Well, that's a good time to change and to move to the week ahead. So looking at the week ahead, we have a number of very interesting issues that are coming up. Now, first of all, the first event to look for is the CPE data that's coming out for the US. Now, the CPE data is the Fed's preferred measure of inflation. Now, the Federal Reserve is America's central bank. It differs from the CPI in its methodology. So this is the data that the Federal Reserve is really focusing on. It's predicted to remain at 2%. It was 2% last time. It's expected to be 2% year on year this time, and 2% is the Federal Reserve's inflation goal. They want to keep inflation at 2%. That is their stated target. And just to remind you, the way you keep inflation in check is by raising interest rates. So when you see inflation rise, so say that CPE figure comes in at 2.5 or 2.6%, then the immediate reaction would be strong growth, we just got that figure in, that figure is 2% versus 2% year on year expected. So that has come in now at exactly 2%. So everything's going on target. So to remind ourselves what the Federal Reserve is doing, there's likely to be one more rate hike in December. So that should take it to a total of 4 25 basis points interest rate rises in 2018. Now, President Trump hasn't been liking the Federal Reserve raising interest rates, but they have to do that to keep the inflation under check. And what's looking like happening for 2019, it looks like at the moment the projection is for 3 rate hikes. So the market's always trying to price in not only what's happening, but what's likely to happen. So at the moment, for the Federal Reserve, We have one more rate hike expected for December, and then it's looking around 3 rate hikes for 2019. Now, obviously, the risks for growth for the US are things like the recent equity market wobble. We've had the big fall in the S&P 500, the Dow. We covered this in last week's webinar, so I won't repeat myself. But that's a threat if that further fall in the equity markets continue. We've also had the trade protectionism, the US-China trade war. So if these factors begin to weigh on the US dollar, then we're likely to see some slowdown in projected US growth. So that's the kind of balance for us to have going forward. Then on Tuesday, the next big event we have is the Eurozone GDP data. You can see that here. Now, it's the initial reading that tends to have the most significant impact, even though it doesn't include Germany's data. But the first read in 2000 in the Q2 was 0.4% quarter on quarter. It's expected to be 0.4% quarter on quarter again for this third quarter. So it's not like amazing growth expected. And as Draghi said during his interview after the ECB met last week, he's saying, okay, it's a kind of a slowdown in momentum. So that's what the market's going to be viewing this GDP data here. Is it a slowdown in momentum, or is it a downturn in momentum? And that's where, if it looks like more like a downturn in momentum and growth, then we're going to see more selling interest on the euro. So that's looking at those figures there and interpreting that in line with what the ECB are doing, as we've already mentioned. But again, okay, if those figures are good, then that's going to look, the euro is going to appreciate, because the market's going to be slightly relieved that slowdown doesn't seem to be coming. And obviously, the greater the deviation from the expected figure, the greater the impact that will have. Now we go Tuesday at 2 o'clock. We have, what do we have? We have the CB consumer price confidence. No, there's nothing there that's particularly going to be moving. Now we have Governor Pollock's, the Canadian Central Bank Governor, speaking at 7:30. Now I think this is interesting. And the reason I'm interested in Pollock speaking is because he gave, at the end of last week, quite a bullish kind of outlook for the Canadian dollar. The outlook was that the NAFTA deal has been arranged and sorted. It's now called the USMCA, United States, Mexico, Canada Agreement. There's a sense of business confidence out of Canada. And Pollock has a habit of surprising the market. He's happy to kind of beat his own path and will change momentum. But the situation for the Canadian dollar has been quite optimistic and bullish. Now, when I looked at the US dollar Canadian dollar pair, I didn't quite see. Where is it? Let's see. Yeah, what I didn't see is as much a strong Canadian dollar bid as I expected. So instead, what you saw when Pollock spoke, you see the Canadian dollar appreciated on his strong comments he's made, but kind of found support here at the 200 moving average. And I was a little bit surprised. So what I'm looking at is to see if some of that Canadian dollar strength comes back in. I'm not really expecting the US dollar Canadian dollar pair to rise above this level here. I would be really surprised because I think there is Canadian dollar strength. Pollock is bullish, so I'm looking at that to see if Pollock is, mentions or puts a more bullish case out for the Canadian dollar. But of course, what you have to remember for the Canadian dollar, and particularly the US dollar Canadian dollar pair, is you can't really trade this pair, and you shouldn't trade this pair without reference to the oil markets. Now, when you look at the price of oil at the moment, and I just put this up for your benefit here, you can see that oil's been falling, and seasonally, oil does tend to fall at this time of the year. That's some of the strong seasonal impacts. that is on oil. And oil kind of found some support here against these lows. See these big support levels here, and the 200 moving average found a little bit of support. But the general move for oil is down, and the seasonal outlook for oil is that it tends to fall at this time of the year as well. So obviously the correlation is, as oil appreciates, the Canadian dollar appreciates. As oil falls, the Canadian dollar falls. So when we look at what Payrolls is saying, we have to also make sure we keep an eye on the oil markets as well, because that will be giving us a really good indication of the likely path for oil. So if you suddenly see oil appreciate, then you can see that you'll see the Canadian dollar appreciate, which would be US dollar, Canadian dollar short. So that's just something to have firmly in your minds as we look ahead. Australian CPI is coming out Wednesday. That's coming out, where is it here? Now, with the Australian CPI, when you've got the CPI trimmed, that's the equivalent to what other countries call their core reading. Okay, so the headline core reading expect to be 0.4%. And the core CPI reading for year on year is 1.9%. So this is significant because these inflation figures are only released once per quarter. So that means its impact can be greater than in some of the other numbers, because you only get the data out once a quarter. So keep your eye on that. That is a market moving data point. And just to remind yourselves, what this means is, if the CPI data is higher than expected, say it's like 2.1, 2.2%, then that means that the pressure on the Reserve Bank of Australia to raise interest rates increases. Now, at the moment, the RBA has been, really boring. There hasn't been any indication of raising interest rates or even necessarily cutting interest rates, although household debt is very high for Australia at the moment. Looking at any deviation from these core figures, which is the trimmed reading, they're the ones you really want to focus on. The trimmed readings, there's the quarter on quarter, there's the year on year. So make sure you've got your eye on that. We've got the Bank of Japan interest rate decision coming out, and that usually happens, that's usually happening around 4:30 a.m. GMT. Now, again, this has been nothing. It's the world's most dovish central bank. Their interest rates are still minus 0.10%. There's kind of rumors of whether that accommodative easy money policy is about to change. But at the moment, everything's just staying steady. It's normally a non-event. But again, if there is any deviation from what's expected, that will have a big impact on the Japanese yen. So that's one to definitely be aware of and take note of and read up what's exactly happened. Got Eurozone inflation coming up as well on Wednesday. Again, that's important for the reasons we've already outlined about the ECB. And obviously, Draghi said that he could see some core price inflation coming up. So if we do start to see some core inflation moving into the data, that would be supportive for the euro. The non-farm payroll data is coming out as well on Wednesday at 12:15. Where is it? Let's have a look. Yeah, here we have the ADP employment change. Now that will move the US dollar because the correlation between the ADP employment change and the non-farm payrolls has is not really a strong correlation, if a correlation at all. But yet the market looks at this data point as expectations for the non-farm payrolls, which are coming up at the end of the week on Friday. So obviously it's 189 expected. So if that's a strong number, then that adds to further speculation that the non-farm payroll release on Friday will be strong as well. So that's just one data point to be aware of. It does move the US dollar. Obviously, better number than expected leads to a dollar being bid, and the less than expected leads to the dollar being sold off. We have the Canadian GDP coming up on Wednesday as well. GDP, that's not going to be particularly moving the market, although remember, we've got to bear in mind with what Payrolls has been saying, and Payrolls speaks again on the Thursday. Let me just flag this up to you. Was it Thursday or Friday? Payrolls is speaking twice this week. When's he speaking? Yeah, there he is. He's speaking on the Wednesday as well. So yeah, okay, GDP data is here and Pollock's are speaking. So remember that Pollock's, when he speaks on the Tuesday, he will probably know what the GDP data is. Okay, so that's just one thing to bear in mind. And then if the market has responded wrongly to anything he said in his speech, then this is a further opportunity for him to clarify it. So if you're trading the Canadian dollar, you need to be aware of these speeches coming from Pollock's, okay, for sure. And he can surprise the market, so you can't ignore him or just not just ignore it completely. We also have the Bank of England decision coming up on Thursday. This is expected to be, no change. We've already covered this. Brexit is really in focus here, and the emphasis in this situation is, will the Brexit deal be ratified with the European Union or not? And then will the UK Parliament vote on it or not? The Bank of England is not likely to raise interest rates at all. And if the hard Brexit deal scenario happens, then we can expect interest rates to fall. And the thing to look at is the votes. So we're expecting the votes to remain completely unchanged. We're not expecting anyone to vote for a cut, and we're not expecting anyone to vote for a hike. Okay, so that's the expectation. So anything different from that is going to result in a reaction in the pound. Okay, and then you've obviously got to look at Carney speaking just half an hour after it. So these data points are basically to be interpreted in line with Carney speaking half an hour later. Okay, so look at the minutes, look at the summary, look at the votes. So who's voting for a cut in interest rates? Who's voting for a hike? It should be no one. That's the most likely thing. And then to what extent will Governor Carney speak about the risks for a no-deal Brexit? That's the kind of rhetoric that's going to have impact on the pound. So that's what you want to look at come Thursday. We also have Friday. The interesting data out on Friday is the non-farm payroll is now recently the average hourly earnings have been having quite a strong impact on the non-farm payrolls, but that's likely to recede now because average hourly earnings are up. They're doing quite well. So I expect emphasis to flip back to the non-farm payrolls job release number. So I'm looking at that headline number now to have more impact than it has done in the last few months, as the hourly earnings have been taking the the limelight. So looking at that headline figure, a strong number is likely to keep the US dollar bid. Obviously, a disappointment in that number is likely to see the US dollar sold off. Just to help you, bid means bought. Okay, so sometimes there's a bit of lingo that's hard to use. Also, look at the employment rate out of Canada. Particularly look at the net change in employment. This data point can really flip around. It's really weird. It's you can have quite extreme readings. You can see, it doesn't. So you just be aware that the change in employment does impact the Canadian dollar, but also be aware it will depend on the participation rate. So obviously, the higher the participation rate, the greater influence these numbers are going to have. Okay, so that's something to be aware of. Look at the participation rate and look at the net change in employment and interpret that in line with Pollock's is saying, the two speeches he has during the week. There's a lot on this week. I'm really aware of that, and I just wanted to help you with some language as well. You will see some of this language, the accommodative monetary policy. Okay, so you'll hear this in reports and analysts. What is an accommodative monetary policy? And this is essentially when the monetary authorities of a country adopt a policy that boosts money supply and lowers interest rates as a means to stimulate economic activity. It's also called an easy money policy. Okay, so the Bank of Japan has the most easy money policy of all the central banks in the world at the moment. Okay, they're minus 0.10%, and they've still got their bond asset purchases. and we can see that the Federal Reserve is winding back from an easy money policy in the similar way that the ECB, the European Central Bank, is winding back from an easy money policy. Also, a tight labour market is when you've got more jobs than workers. Okay, so if you hear about a tight labour market, all that means is there's more jobs than workers. And if there's more jobs than workers, that means wages tends to increase. Okay, so as soon as a central bank sees a tight labour market, that means there's more jobs than workers, which means those workers are going to get more pay, which in turn means that inflation is more likely to increase, which means interest rates are more likely to rise. So I just wanted to help you guys with understanding financial language. There's so much jargon, and I just thought, you know what, this is quite relevant for this week's FX week ahead. So I wanted to give those to you guys just to help you in your education and your development. And on that note, I have some good news. And the good news I have is that starting from tomorrow, there's some workshops starting tomorrow at 1 p.m. GMT every Tuesday. Okay, now that's going to be with me, and it's going to be 1 hour live market experience, where you're going to see how I approach the markets when I come to trade on an intraday trading basis. So there's going to be nothing held back. You're going to be able to chat, ask questions just like this webinar, and you're going to be able to see how I approach putting into practice some of the knowledge that we've been sharing in the FX week ahead. You have to have knowledge to trade the FX markets, and you have to have a good fundamental understanding, and you also have to have a good technical understanding. You do need them both. And the idea of these workshops is that they're going to be opportunities for you to practice your online trading skills. So you're going to see how I apply technical analysis to my fundamental analysis, and then you're going to be able to practice your online trading skills. So all you have to do, if you look in the chat box on the right hand side, you just join the free weekly online trading workshops by hitting the link there. When you hit the link there, you open a demo account, and then I'm going to be helping you to put all these this knowledge into practice. You know the old saying, practice makes perfect. Well, it's very true in the foreign exchange markets. You have to practice your skills. You have to develop them. They take a long time to develop. They don't happen overnight. So this is the new HYCM service that's going to be provided for you guys. I really am looking forward to it, and I think we're going to have a really good time, and I'm looking forward to drilling down to some of the detail and showing you how we apply some of the knowledge that we've been looking at. That's great, guys. Thank you very much for another week. Thank you for your questions. I think I've got all your questions. If you've got another question, just ask me. That's great, Rahul. I'm glad that cleared that up for you. And if you've got a question, ask away. Otherwise, I will be back here tomorrow for the workshop at 1 p.m. GMT every Tuesday, and back again this time next week on Monday, the 5th of November at 12:30 to 1 o'clock GMT time. Okay, guys, I don't think there's any questions, in which case I look forward to seeing some of you tomorrow. Make sure you check out the chat to register for the online trading workshop, and thank you very much and have a good week. Goodbye.